let me tell you about two investors, same city, same starting capital $100,000, same year 2004. One bought a rental property. The other put everything into a diversified stock portfolio. 20 years later, one of them retired, the other is still working. And here's the part that will genuinely surprise you. It's not the one most finance influencers tell you about. Today, we're not doing motivational fluff. No, real estate builds generational wealth platitudes. No, stocks always go up long-term gospel. We're doing the actual math, unfiltered, and by the end of this video, you'll know exactly which vehicle performs better, and more importantly, when each one makes sense for your portfolio. Let's start with what most people compare, and why that comparison is almost always wrong. If you bought the S&P 500 in January 2004 and reinvested dividends, your $100,000 would have grown to roughly $720,000 by early 2024. That's a compound annual growth rate of about 10.5%. Now, the average U.S. home price in 2004 was around $195,000. With a 20% down payment, your same $100,000, you'd control a $195,000 asset. By 2024, that home's value is approximately $420,000. On the surface, that looks like stocks won, easily. But here's where most analysts stop, and where the real analysis actually begins. Because you forgot something critical: leverage. This is the variable that changes everything. When you invest in stocks, $100,000 buys you exactly $100,000 worth of assets, period. But in real estate, that same $100,000 down payment gave you control of a $195,000 asset. Your return isn't calculated on $100,000, it's calculated on the full property value, while you only deployed a fraction of it. So your $420,000 exit price minus your original $195,000 value gives you $225,000 in appreciation on a $100,000 investment. That's a 225% return on capital deployed. Compare that to stocks. $720,000 on $100,000, a 620% return. Stocks still win on paper, but we haven't added the rental income layer yet. If your property generated even a modest $1,200 per month net after mortgage, taxes, insurance, and maintenance, that's $14,400 per year. Over 20 years, conservatively adjusted for rent increases, you're looking at an additional $400,000 to $500,000 in cash flow. Now rerun the math. Real estate total return, somewhere between $600,000 and $700,000, suddenly neck and neck with the stock market. And with a hard asset you can physically touch, refinance, or borrow against. Here's where I'm going to make some real estate investors uncomfortable, because leverage is a sword that cuts both ways. In 2008, the same leverage that amplifies your gains became the mechanism that wiped out thousands of landlords overnight. A 20% drop in property values doesn't cost you 20% of your investment, it costs you 100% of your equity if you're overleveraged. And then there's the hidden cost structure of real estate that never shows up in the highlight reels. Vacancy rates, property management, typically 8 to 12% of gross rent. Capital expenditures, roofs, HVAC, plumbing. Property taxes that increase as values rise. Transaction costs of 5 to 7% when you sell. The average landlord underestimates their true expenses by 30 to 40%, which means that passive income is often neither passive nor as profitable as projected. Stocks, on the other hand, carry their own hidden tax behavioral risk. The average retail investor in the stock market earns roughly 3 to 4% annually, not 10%, because they panic sell in downturns and chase performance in bull runs. The market returns 10%. The average investor captures less than half of that. Two different assets, two very different ways to lose money if you're not disciplined. So which one wins? Let me give you the honest answer that nobody wants to say out loud. It depends on 4 variables. 1. Your local real estate market. Real estate is hyperlocal. A $300,000 property in Austin in 2015 and a $300,000 property in Detroit in 2015 are not the same investment. National averages are almost meaningless for individual decisions. 2. Your tax position. Real estate offers depreciation deductions, 1031 exchanges, and mortgage interest write-offs that can dramatically change your after-tax return. If you're in a high-income bracket, Real estate's tax efficiency can outperform stocks, even when the gross returns are lower. 3. Your time horizon and liquidity needs. Stocks can be liquidated in seconds. Real estate takes months, sometimes more than a year in illiquid markets. If you need capital flexibility, this matters more than any return number. 4. Your operational capacity. Real estate is a business disguised as an investment. If you're not willing to actively manage it or pay someone to do it properly, your returns will suffer. Stocks require almost nothing from you operationally. Here's the conclusion that sophisticated investors actually reach after running the real math. The question isn't which asset class is better. The question is, which combination is optimal for your specific tax situation, capital base, risk tolerance, and time constraints. The investors who consistently build the most wealth aren't the ones who pick a side. They're the ones who understand when to use leverage for cash-flowing real estate and when to stay liquid and let compounding work quietly in index funds. The two investors I told you about at the beginning of this video, they both did fine. But the one who retired early, he owned both. He just knew when to deploy each one. And that's the math nobody puts in the thumbnail.